Traders, welcome back. Second session of 2022. As always, got a brilliant institutional Sunday for you. Gonna keep it short, places to be, people to see, and all of that. But on a serious note, I am gonna try and keep it short, which is good. So no excuse not to watch it. Another reason to watch it is that it doesn't matter what you trade. I say it all the time. Everything's covered here. We're going to be talking about the US Treasury. We're going to be talking about Bitcoin for a couple of minutes, Forex, and obviously the S&P, and then energy you can see here. So let's get into it. So looking at last week across all assets, and we're actually going to look at my own performance as well, which is quite important for month to date. But firstly, let's have a look at what happened in markets. We can see that oil definitely the outperformer last week, and you saw that in the energy sector being one of the only sectors in the equity market that performed well last week. The rest of the market, I wouldn't say tanked, but obviously had another negative week. We're down, I think 2.2% now in the equity market. Again, that was a drag on Bitcoin. You can see Bitcoin having a pretty terrible performance so far this year, being dragged by the same factors that are driving the equity market. You can see that here. You can also see dollar yen off heavily, right? Things going on with Japanese monetary policy not helping, but also, the risk off sentiment so far that we're seeing this year being driven by generally expectations of the Federal Reserve going to be hiking very aggressively this year, maybe 4 times. We're going to talk about that very briefly. In a nutshell, another poor week for the equity market and kind of risky assets. We've seen kind of yields again outperform in terms of rate rises. We can see that here, back up towards the highs of around it says 1.78 there, so about 1.8%, and then crude oil obviously rallying as well. So let's get into it. So as I said, I want to just talk a little bit about my January performance. This is my trade blotter, as you guys know, in my live account. If I just remove the filter and let's just look at this year so far. So just breached $10,000 for the month, couple of weeks in, so not a bad start. We can have a look at the detailed performance here. Very low MAE, just $1,000 on average risk taken per trade in terms of adverse excursion. Commissions, very low commissions because I haven't traded that much. 8 trades in total, 10,000 gain. Now the thing that's quite interesting is longs versus shorts, and that's why I want to bring this up. Let me see if I can actually find it. Let's go to compare and let's have a look at, can't remember exactly what it is. I think it's this, long and short. 1st of January, very, very interesting to see the just above $10,000 that I've made this month. Where has that actually come from? And you can see, even though I've been quite bearish on the market, pretty much, in fact, I've had minus $75 on the short side, but 100% of my gains have come from longs. Okay, and there's a lesson there. Okay, just because my bias has been short in institutional Sundays, I've made all of my money getting long of the market. And actually what that tells you is that it doesn't mean that I've been fading the market, and I have. What I mean is that it's helped me to have a negative bias, because rather than getting aggressive when the market is moving up, what I've been doing is waiting for the market to sell off, because I've almost been expecting it, because I've had negative sentiment, as you know, in my institutional Sundays, and then looking to fade off extreme levels near after sell-offs. Okay, so rather than shallow pullbacks, I've been waiting for negative sentiment to build, because I've been expecting it in terms of obviously the market being negative on Fed stance and so on, which we're going to get into in a second. So hopefully you can see it's a very important nuance that you need to understand why positioning can matter, and where and when you get aggressive can make a big difference. And that's where the fundamental picture obviously has been helping me. What we're going to do anyway, we're going to get into S&P performance last week, you can see here down 0.3% on the week. The week before was minus 1.9%, I believe. So it's 2.2% off the highs, because we just made the new high right on the, I think it was the last day of the year. So minus 1.9 last week, minus 0.3, so another down week. So equity market and obviously all the risky assets like Bitcoin continue to be off. Where did we see the majority of that? After the inflation. Okay, so I heard a lot of people blaming weak earnings on Friday from the banking sector, but actually the majority of the sell-off happened on Thursday. I think the market is now starting to finally register that there are going to be rate hikes, and not only one, several this year, and likely to start as soon as March. I think the market is now pricing in 100% chance or 95% chance of a rate hike in March. I think this is dawning on the market now. Inflation still remains high, which we've seen. Let's have a look at that. So you can see here, just want to make sure I'm not blocking anything. Very quickly, we're going to go through the inflation picture from last week. So believe it was on a year-on-year basis, again above 7%. So, you know, multi-decade highs. Month-on-month, 0.5% on the headline and 0.6 on the core, right? So very, very punchy inflation numbers. The market did have a bit of a muted reaction to it. You can see here, it was more of a kind of a lagged reaction to it. A lot of people said that was down to the fact that it was, you know, not way above forecast, but I don't really buy it. For some reason, the market had a slightly delayed reaction, but I think the reaction was telling the day after, where we did kind of sell off, and I think that sentiment followed through. Partly because obviously these rate hikes are now being priced in very, very aggressively to around 4 rate hikes. So you can see that here. Okay, so first chart we're going to look at on this page, this is rate hikes priced in by the Fed for 2022. Okay, so 4. Right? You can see how over time, as we come into now January, how the expectation has risen dramatically now, in line with obviously the inflation picture, which you can see was around 7% overall, but when you break it out, mainly being driven by goods, right? So 10.7% good, 3.7% services. And when you see kind of where's this coming from, you know, rent, used cars, new vehicles, furniture and bedding, you know, obviously the Fed, we're talking about this being transitory and not being broad-based. Completely wrong on that. We know that now. It is very broad-based. You know, when your rental and your you know, furniture and bedding and things that you're using every day are going up in price, that means it's not, you know, it's very broad-based. So the Fed had that wrong completely. We already know about the transitory commentary that they were using, obviously very, very wrong on that. So the market is now quickly adjusting its expectations that we're going to get 4 rate hikes. I don't have the chart here, but it is, I believe, 93 to 95% for March now. Talked about this last week, that it is going to potentially keep the equity market in check, and that is exactly what we're seeing. You know, no surprise. On the plus side, just to finish off, as I've said, if you look at the equity market reaction, I think this is over the last 50 years. On average, in a rate hiking cycle, you can see here, after the first rate hike, we do see some underperformance in equities, but then it tends to come back. And I've talked about this many times in many institutional Sundays, so that continues to be the expectation. A little bit of this weakness to continue over the coming weeks. We may see, you know, and there's a good opportunity now for us to talk about next week. We may actually see some respite next week ahead of the Fed meeting in week 4, because next week the data calendar is very quiet. We've got a bank holiday on Monday, so you can see that there. This next week's calendar, and normally retail sales would fall in this week. We had retail sales which was fairly weak, but not really worth getting into, because it was just obviously the first release of the year in terms of retail sales, albeit for December, which was the last month of the quarter, but we had a very strong September, I believe. So generally, overall, the quarter should remain strong in terms of the growth effect for that. But point being, retail sales normally would be in this week. We don't have that. So literally, really nothing on the data front. So that means the full focus will be on earnings. Okay, very, very important. So we may get some respite next week. Looking at earnings, again, expected to be quite a strong season for earnings. We had a little bit of underperformance on Friday, but still expected to be fairly strong. We can see so far, generally the majority of earnings have been upside surprises. Okay, so we're seeing that upside surprise kind of tail off now as we get into Q4. Obviously, the the year on years are going to be tailing off, which is normal because the kind of base that you compare that to is changing now, right? Obviously, the corona situation was in 2020. So you're comparing 2021 figures when you look at your year on years to 2020, you're going to have these high year on year earnings growths. That effect, that base effect is now obviously tailing off. Having said that, still expecting very, very strong earnings growth of, on an annualized basis, around 22% for the fourth quarter. So still very, very strong. Q1, obviously not so much certainty. Some of the late Omicron surge may have an impact on that. But point being, still, kind of expecting a strong earnings season. And I'll get more and more into the details in next week's Institutional Sunday as more numbers come out, earnings come out next week. So like I said, to summarize, really expecting, not anything great from the markets over the next few weeks as we head into the March Fed rate hike, although next week we may see some respite because obviously earnings will be in focus, especially as there's very little on the data calendar. Click the button to subscribe. Watch this video if you want to see my latest live trading, highlighting the $10,000 and some live trading as well. Click the button. Have a great week and a weekend. See you next week.